Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Thanks for tuning in to Modern Investing Techniques, episode 89. It's June 27th, 2026, and I'm Patrick in Vancouver. Time to break down today's market setup and find our edge. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. UnitedHealth's quiet 80% climb off lows shows healthcare can still deliver defensive alpha when broader indices stall. The S&P 500 closed at 7,354 and finished flat. The NASDAQ Composite closed at 25,298, down 0.2%. The TSX Composite closed at 34,980, up 0.4%. Sentiment stayed cautious after fresh U.S.-Iran tensions and hawkish comments from Kevin Warsh reduced odds of near-term rate cuts. Consumer staples and healthcare led the session while tech and energy lagged. About 14 days ago, we picked KO for its pricing power, and it closed flat today, reminding us defensive names protect capital but rarely outperform in sideways markets. A covered call ETF strategy lets investors collect premium income on holdings they already own by selling out-of-the-money calls each month. Today's flat equity tape and elevated volatility make the approach attractive because premiums remain rich while downside risk stays contained. Implementation is straightforward on Canadian platforms. Buy an ETF such as ZWC or QYLD inside a TFSA, then sell the front month call at the 30 delta strike using the brokerage's options chain. The tactic has historically added 4 to 8% annualized yield in sideways or mildly bullish regimes. It caps upside during strong rallies and can underperform in sharp drops. Position sizing matters. Limit covered call exposure to 15 to 20% of the overall portfolio, so the income sleeve does not dominate total return. Track the strategy's net performance against a plain vanilla equity ETF each quarter to confirm the income premium justifies the opportunity cost. This is a simulated trade for educational purposes only. No real money is involved. Our practice investment of the day is UnitedHealth Group on the Northern NYSE. The strategy is a mean reversion entry on the stock's 80% recovery from lows with volume confirmation. The hold period runs Monday through Friday. The catalyst is that the stock has quietly risen 80% from its recent low, while broader healthcare peers remain range-bound. Price has reclaimed the 50-day moving average on above-average volume. Nearest support sits near the 20-day average, with resistance at the prior swing high. A retest of the low would trigger a 7% stop loss, limiting simulated loss to $70 on a $1,000 position. The target is plus 4 to plus 6% over the 5-day window if momentum holds. Confidence is medium because recovery breadth and sector defensive characteristics align, yet macro rate sensitivity remains an uncertainty. This trade demonstrates how to size a recovery setup using a clear stop and a modest weekly target while staying inside the 1% portfolio risk rule. Listeners learn to wait for price confirmation above a key moving average before committing capital, rather than guessing the bottom. Yesterday's flash trade was an MU on an AI momentum entry tied to an earnings revision catalyst with volume confirmation. We entered at $1,233 at the open and exited at $1,213.56 at the close. The result was a loss of 1.58%, or $15.77 on a $1,000 position. The earnings revision catalyst produced an immediate reversal once broader cost concerns resurfaced. That underscores the need for price confirmation. The rule we take away is to require closing price confirmation before declaring any catalyst trade complete. The Coinbase AI agent lets users define rules-based crypto trading parameters that execute automatically inside the Coinbase app. It removes emotional decision-making on volatile names and is most useful for investors already comfortable with small crypto allocations who want 24/7 execution without constant monitoring. Access it through the Coinbase Advanced Trade interface at the standard commission schedule. The Benzinga Forex Analysis Framework walks through combining fundamental drivers with technical levels to build a repeatable Forex decision process. Canadian investors holding US dollar assets can use the same framework to hedge currency exposure inside a TFSA without needing a separate Forex account. The article is free on the Benzinga site. AI memory demand drove Micron's explosive earnings report that outpaced even Nvidia's recent prints. Add MU to the watch list and wait for a pullback to the 20-day moving average before considering a re-entry. SpaceX briefly breached and rebounded from the psychological $150 level. Hold existing SpaceX exposure and do not add on strength until the next option's expiry cycle clarifies support. Bitcoin is holding above $60,000 despite funding model scrutiny. Maintain current crypto sleeve size and tighten stops to the $58,000 level if the next daily close falls below $60,000. Divergent capital efficiency models between Lennar and NBR create a relative value opportunity inside the housing sector as rates stabilize. Review both names in a sector ETF screener and consider a small pair trade sized to 1% portfolio risk. Total simulated trades stand at 41 with a 51% win rate. Cumulative profit and loss sits at $263.15. Cumulative alpha versus the NASDAQ across 30 benchmark trades is plus 11%. Average return per trade is plus 0.64%. Our AI analysis is learning from patterns around catalyst confirmation and adjusting entries accordingly. Imagine you bought 200 shares of a healthcare name at $480 last week after an analyst upgrade. Your order filled cleanly at the open. The position now represents 18% of your TFSA because you sized it by dollars rather than by risk. A 6% adverse move would wipe out an entire month of expected gains. The mechanism is simple. Maximum loss equals position size multiplied by distance to stop. If you risk only 1% of total capital per trade, a 6% stop requires the position to be no larger than 16.7% of the account. Professionals always calculate the dollar risk first, then back into share count using the planned stop level. The biggest mistake with position sizing is letting a high conviction idea exceed the 1 to 2% risk budget. Instead, always predefine the exit price and the maximum portfolio impact before the order is placed. Before we wrap, open your brokerage platform tomorrow and mark the 50-day moving average plus the 7% stop on UNH to see the exact share count that keeps risk at 1% of your TFSA. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. And before you go, this show is part of the NARA Network, a family of daily podcasts on tech, science, and markets, each one a short, sharp briefing you can finish on the commute. If today earned its place in your feed, here's your next listen. OmniView, a balanced daily world news briefing that takes every side seriously. Find every show free at naranetwork.com. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't laugh?